Hello, everybody. Welcome back to another episode of Local Living with the Reid Casey team in Keller Williams, North Atlanta. I'm Reid Casey, and we are so excited to talk to you today. We have a special guest, Steve Golden with Gannick PC. He is our preferred closing attorney. Steve does an amazing job. He's been around forever. He does a ton of knowledge on all aspects related to real estate. And we're going to talk today about owner financing, which I think, Steve, is probably a subject that doesn't get talked about enough.
Right.
It seems like, back in the old days of real estate, maybe like the 60s, 70s, 80s, especially in rural areas, owner financing is something that they do all the time. You can correct me if I'm wrong, but around here, it's not as much. And with interest rates kind of being a little elevated, it seems like something that may be a good topic for our sellers and our buyers.
Right, right. Yeah. A couple of cases come to mind. We had a young couple who, both were employed, but, just didn't meet the Fannie Mae requirements, to get conventional financing, FHA and VA. And so, they wanted to purchase a home and they fell in love with a home in Roswell. It's historic. And they just, had a real passion, for this home. The owners, had their property free and clear, which opened up an opportunity. We matched them together, well, a realtor did. And the sellers, called me and said, Steve, we're interested in possibly doing an owner finance deal with these buyers. They have a little bit of money to put down. We believe in them. We like them. How does it work? So that was one scenario. And we'll go back to that one. Another scenario was you had a guy who was self-employed, an entrepreneur. He had a lot of money in the bank, but not enough to buy the home that he wanted. And he wanted Milton. He wanted, horse farm. And so, he was able through his realtor to find a seller that had the property free and clear. And so at the end of the day, he said, I want to buy it. The seller said, well, if you put enough money down and you hedge the risk for me, and we have an exit strategy here where, I don't want to be your lender for 30 years like Fannie Mae, but, 1 to 2 years, and it worked great. So, we structured the deal, and I'll tell you all about that here in a minute. And the deal, was where, a promissory note was signed. We collateralized the note with a security deed. So, the seller, who's now the lender, had a secured interest in the property. And, after about, I think it was 1 to 2 years, he paid them in full. So that's really important when you structure these owner finance deals. When you have a seller becoming the lender, we need to know, is it going to be long term, which most of the time sellers don't want. They want it to be a mezzanine type, scenario to where they're just bridging the gap.
Yep.
And you have to understand the why. Is it an adverse credit implication? Those you might want to steer clear of, because if you are a lender, and the buyer, your borrower, has had credit issues in the past, I mean, it could be indicative, of future performance. Not necessarily, but we've had cases, where people have taken a chance on folks and it's worked out to be fine. And we've done a couple of times, owner finance deal where his mom and dad selling to their son and daughter-in-law, and they said, we're going to finance this for them. But the key is that you have property that's free and clear. And that's really important to understand because, most loans have a due on sale clause. So if you transfer title and you're doing basically, an assumption, if you will, without the lender's permission, they can call the loan due, and the new buyer, their interest could get cut out. So we have to make sure and verify that the property is in fact free and clear. We have to understand the why. We do need, to run, a credit, report, which is important. And that's a real critical piece, to it, because, you trust but verify. And what I recommend folks do is that they go to a good local lender with the proper consent. Two things. One, you get them to pull the credit that they can share with you and kind of look at it through the lens of what a savings and loan bank would do, Fannie Mae would do, those kind of guidelines. In fact, in the exhibit, the GAR form, it has language in there that the buyer, will, within X period of time, from the binding agreement date, provide the credit information. and the seller will look at it through that lens of Fannie Mae. They won't unreasonably withhold, loan approval, but at the same time, if it's not a palatable risk for that seller, they can deny it, and the deal automatically terminates, and everybody walks away. So it's a smartly done form. And then you get into the okay, you got a seller and buyer, it's a match. Everybody's good with the concept of it. The whys, the credit, all that's done. Now we need to talk about the terms of the loan. And that's very, very important because if you don't get the interest rate right, the problem is you could have adverse tax, implications. The IRS they have a publication of basically the applicable interest rate, federal rate, and it's got to you got to meet that minimum. So what they don't want is for people to have a 1% interest rate, that kind of thing. They want it to be par, which would be about I think I closed one. We checked with the local CPA, the seller did, and it was 4.7%. I think I looked, it's in the mid fives, and it ranges just depending on whether it's a short, mid, or long-term loan. So we got to get a CPA involved or a tax attorney to verify the rate. So then the term comes into play, and that's part of the exit strategy. So if you're meeting with, a loan officer to number one, get the credit, looked at. Number two, you want to look at that exit strategy. So is it a 1 year term? Is it a 2 year term? Do you want a balloon lump sum payment at the end? We've created notes where there's a mechanism where it could extend out if need be. So, let's say, for example, it looks like you only need a year, for the mezzanine middle step to where they can do a refinance and they can take the seller out. Well, in that case, we would look at, maybe a 1 year term, interest only payments, maybe a 30-year, amortization, something like that, but with a mechanism built in to where you could actually extend, for another 6 months if need be, with proper notice from a borrower, to their lender, which again is seller and buyer, and they might have an increase in interest rate, to buy that time, if you will. So we look at the terms, we talk to the parties, we prepare the promissory note. You want to kind of have that in place before you go under contract, because in that exhibit that's part of the purchase and sale agreement, the first paragraph, you want to, list out the terms. And I like to go ahead and prepare the note and security deed at least during the due diligence period, so everybody's on the same page. We look at it together, we modify it, tweak it. But if you do your proper due diligence, the credit risk is minimal. It's a neat option for a seller and a buyer, to come together. And you're exactly right at the very beginning when you're talking about the way it used to be. I mean, there was minimal bank options, it was more rural. People would, not necessarily do a handshake, but they'd have a local attorney, maybe, in overalls and, gardening gloves.
Just got off the tractor.
Exactly. Just got off the tractor and said, okay, so you want to buy, 2 acres, of this parcel. Okay. So, we're not going to go to the savings and loan. We're not going to go to the local bank. I've owned this property for years. I'm okay with you paying me back over time. Put some money in the deal, pay the taxes, pay the insurance, on it, and that's another thing to talk about too, are the taxes and insurance. You want to make sure that you have a homeowners and policy in place. And the mortgagee clause needs to be the seller. They need to be in first mortgage position. That way, if the collateral is damaged, fire, some, kind of, covered risk, the mortgagee, the lender, would be covered, and they would have the ability to get paid in full. And then, of course, the buyer could, rebuild if they wanted, or use the proceeds to rebuild the home and keep the loan in place. So there's some options there. Taxes need to be paid. Few times we've had, folks want to do a escrow account. The seller felt very strongly. Absolutely. Yeah. We set those up and we can help manage those, for the folks, and do a reanalysis every year for them. We have the technology to handle that. if they want to do it. But at a minimum, the security deed that we have as a requirement for the buyer to provide proof, of the taxes being paid if requested. And, they need a current homeowners insurance policy in place. So, we talk about that. We talk about what happens, if non-payment is made, not made. And, if there is default, we kind of go through the process that you have a right to cure, that ultimately, if you don't do that and you don't sell the property to get the loan paid off and you don't refi, your lender can foreclose. It's fairly quick in Georgia, non-judicial. We never want that to happen. But as attorneys, we have to be very clear with everybody, and everybody needs to be on the same page that this is a possibility if you're in default. It securitizes the loan. It gives the seller some comfort to know that I've got a secured interest in the property, and that if there's non-payment, it's not an arduous process. There are some hurdles that you have to overcome, potentially like a bankruptcy. But at the end of the day, it's possible to foreclose, take the property back, and then they can sell it, to another third party, but if properly done, and you do your due diligence, you know, most of the time it works out just fine. And it's a great option. And we're happy to help with that. Now, the last thing, and we can talk about a lot more, and, I've got so much I could share, is let's say you've got the borrower, and they said, okay, with the entrepreneur type, he's like, listen, I've got a big infusion of cash. I can go ahead and pay you in full. And the seller's like, well, how in the world do I, calculate a payoff? I mean, we got this thing as kind of it's a balloon type deal, interest only payments. He's made some principal reduction payments along the way. It's really confusing. We can help with that. We can come up with a payoff letter, do the math for him so that, you'll have an exact number that makes sense with a good through date, just like an institutional lender. And then we'll help, provide that payoff letter, whether it's, part of a sale, part of a refi, or, like the entrepreneur getting a lot of cash in and having the ability to pay that loan in full. So we help from beginning to end through that process, and it's been fun. I mean, like I said, I helped a family recently, and that was, really cool. I really loved helping, that young couple, with, the home they fell in love with. And the sellers, they were moving on. They were retired and they were ready to go to sunny Florida, and they loved Roswell and they loved their home, but it was time for them to go. And so, but it was one of the best closings I did. It was just good feelings, and the buyers were like, "Thank you so much for giving us an opportunity," because we were going to have to lease for a while, and the sellers didn't feel comfortable with the lease type situation. They're like, "We really want to sell. We want to get out of here. We want, an end to this." And I think we did on that particular note, I think we did a 2 year, uh, um, 30-year AM, balloon. So at the end of 2 years, they would have to pay it in full. We did have a mechanism to extend it, but we didn't need to do that. They were able to, get, a Fannie Mae loan at that time. They were able to do a refinance because they established their credit, and it was a win-win situation for everybody involved, and we were happy to be a part of it.
So it sounds like the key points that I've taken away so far are obviously the property needs to be free and clear. Doesn't need it, and it can't have a current mortgage. Typically, from what I'm hearing from you, you see short term, 1 to 2 years, 3 years. Is there a reason why a seller or a buyer, I guess a buyer, if they couldn't get conventional financing or pay off by conventional financing, they would need to extend? But for a seller, is there a reason why they would want to extend this? Or do you see most sellers want to kind of just use this as a tool to get the house sold, get the property sold, and then be able to get their cash out within a few years?
Yeah, we've had a few scenarios over the years where people like getting that monthly check. It's deferred equity, and so they were okay with it. The rate was a little bit higher. The buyers liked it. Another point too is that there's a lot less closing cost involved. So yeah, the closing costs are really like a cash deal almost. I mean, there is going to be some per diem interest, collected up front, possibly escrows if we set those up. All the usual title charges would be in there, transfer tax, possibly intangible tax if the loan term's over 3 years. Prorations, like a standard, type sale with HOA and taxes. But at the end of the day, it's a lot less expensive, to do private, financing. Every now and then you'll have a seller that says, well, this is a premium. I'm taking a risk here, so I'm going to want some more money up front in the form of points. I mean, we've had one case, where we did that, and we had one seller who was like, I'm cool with 30 years. I like getting a check in the mailbox every month. I get a check, and I'm good with that. But my experience has been that most of the time it's mezzanine, it's a middle, it's just a means to get the deal closed. And, sometimes it could be a unique property where it's been sitting a little bit and the seller's like, listen, I need to get this sold. I need to get on to the next step, and I've got the ability to provide owner financing. And it's a unique, thing that might open up the pool of buyers a little bit more.
Well, it sure would, and on my end, on the sales and marketing side, it sure would be nice, to have that on my tool belt to be able to market to a larger pool of buyers. I mean, even in here in Milton, property values aren't inexpensive.
Right.
Even on a large land deal that may be owned by an estate, sometimes we see an estate where a property's been paid off. It can open up your pool of buyers for people that can afford
Right.
to buy large acreage parcels, where they just need to get a few ducks in a row, maybe get some investors involved to be able to pay off a mezzanine loan
Mm.
in a year or two to go ahead and so it opens up our buyer pool, I guess is what I'm trying to say.
Right, right. Yeah, and and I know some builder developer types that, they like to leverage their dollars a little bit more. So if they can get an owner finance deal, we had one where it's a $2 million transaction, and the builder put in, $1 million, financed the other, million. And he said, I want to save my cash because I never know what, is around the corner. So, I might want to buy something else. And, typically with this guy, we would do a 1 to 2 year term. It's usually 1 year, interest only payments with the option to extend for another 12 months, but usually it's paid off, fairly quickly.
Yeah, yeah. Oh, man, that's great. This is fantastic, Steve. Thank you so much.
Very welcome.
That was a lot of great information fairly quickly.
Oh, sorry. My mind works a little bit differently. I think it's the third cup of coffee. But no, I'm always willing to take a call, that, and always willing to help talk to people, and just give them the nuts and bolts, and the risk. I don't want to, paint a picture where it's going to be all, roses and rainbows. Sometimes, you've got buyers that, don't have the best of intentions, and they get in the home and they don't make the payments. And now you got a seller saying, well, I got somebody in my home. How does this foreclosure stuff work? And, but most of the time, if you do your due diligence and it's properly explained and you get the paperwork done right, everybody's happy. It is a unique thing. And, we are seeing it trend a little bit more. And, it's okay. But I like the idea of getting a local lender involved for the credit check. I think that's important. And also to establish an exit strategy. And you kind of back into the solution by everybody talking, getting that, figured out through the lender and the CPA. You pull all the information together and you put the paperwork together and you're good to go.
Well, it seems like it's an opportunity for some of our lenders. I mean, some of our best friends and people we rely on the most are some of our mortgage brokers. And it seems like some of the maybe candidates who have come to them to obtain financing that maybe don't have all of their ducks in order yet, properties that would check some of these boxes to get owner financing, and the lender can continue to work through them as they build their credit or their down payment or whatever it is. And then the lender obviously would hopefully get the business after they've helped him go through that process, but give a seller a lot of confidence to go ahead and take on some risk like this.
Absolutely, because, the more you can minimize the risk to the seller, I mean, it's really a win-win, for everybody. And, if you got, a local lender, we know some of the same folks, that you rely on, they can, tell you, okay, here's where they can establish enough credit, to take out the first mortgage. And that gives the seller confidence to move forward with the deal. Two, it kind of gives us some guidelines on how to structure the terms. And, again, you have some sellers who are just like, love the mailbox check, hey, 30 years and I'm still getting checks. This is a wonderful thing. Others are like, I'm making the deal happen, but, this is deferred equity. I don't want to defer too long. I prefer to get that money, in my account.
Well, it's one thing for realtors to know is, and it's not something that we practice very it's not very common that we call somebody on a listing that we may fit a buyer need that we have and ask them, is this paid off? Would the sellers be open
Mhm.
for owner financing terms? It's just not something that we do often. So I would encourage agents to start doing that, having those conversations, maybe open up some inventory. We need to get more inventory and options for buyers. It may help loosen that up a little bit.
Yeah, absolutely, and we can help, explain. We can also help verify that the property is in fact free and clear. We have some sellers that think, well, I do have a mortgage, but what's the big deal? We can go ahead and do the deal. We've had some situations where, sellers have taken back a second. If they've got a first mortgage existing and there's a due on sale clause, we can't get around that. I mean, we typically represent lenders. It's fraught with peril with the due on sale clause. So, we don't move forward with that. But I had one recently where there was a seller second. So, institutional bank was doing the first mortgage. The buyer needed a little more help, and the first mortgage lender was cool with it. So, so we put together the terms on that, and it hasn't closed yet. But at the end of the day, it's a small loan, and it'll help the buyer, with their down payment. And one of the things I was thinking about, is the NAR settlement too. Where you're going to see more decoupling, where buyers are going to be paying, or be obligated to pay, the buyer, their agent. And so, it could be a scenario where, okay, well, maybe we can finance that in the deal, for, with a seller second, or maybe the first mortgage lender will have some way of, rolling that in if the seller's not willing to give a concession. And if the seller's agent, is not going to co-op, and share, in the compensation. So, we can look at it, in totality and just say, okay, is there a need to do a seller second? Does it make sense? But don't want to get, too much into the weeds on that, but at the end of the day, I always say, it could open up inventory. It could be a unique, type way, to get like, that historic Roswell house with that young couple that just had a passion and they had so much vision for it. They wanted to keep it true, to its original state, both artistic types and, the sellers just loved them. And they were like, we want them to have this home and we want to make it happen. And it was a great way, to bridge the gap. And as far as I know, they're still living in that home and enjoying it.
Yeah, that's great. That's great. Thank you so much, Steve, for being here today. So the bottom line here is, if you're thinking about owner financing, if you're thinking about marketing a home that is paid off for your seller and they're open to owner financing, just call Steve. I mean, that's what we're learning today.
Yeah, call me. I'm always glad to help. You know that. I mean, I'm always a phone call away. If you want me to verify, that the property is in fact free and clear, if you want me to, talk to a seller, about the mechanics, as to how it works and what the potential risk is and things to look out for, and a buyer, what does owner financing mean? How does that work? And, when preparing the contract note and security deed, I can help with all that. So one-stop shop.
That's great. I love it. Thank you so much for tuning in to our latest episode of Local Living with the Reid Casey team in Keller Williams, North Atlanta. We're so happy that you're here with us. Make sure to subscribe on all podcasting platforms. And if you are watching on YouTube, make sure you hit that subscribe button so you don't miss another episode. Thank you so much, and we'll talk to you soon.